Okay, I'm Blake Marsh. I'm from the Federal Reserve Bank of Kansas City. I want to thank the conference organizers for having us here, and Alan and Kevin for putting together a discussion. So this is joint work with my colleague in Kansas City, Rajdeep Singh Gupta. So I have the standard disclaimer that the others have. This is my own views and not the views of the Federal Reserve. I think one interesting thing is that this paper is actually an outgrowth of separate papers that Rajdeep and I were working on in the past, and both of those were in previous versions of this conference. So I think it's great that this avenue, exists and that we can continue to sort of look at these community bank issues and continue to expand the research. So the paper asks a very simple question: how does competition affect bank fragility? And what we're interested in here is we're going to use empirical evidence from local banks in the United States between 1990 and 2005, and we have an interesting laboratory here to test this in. So in the 1980s, state regulation made all banking local. And over time, these regulations were dropped. And this happened through at the state level at various different times. And this was followed by a period of large bank entry into these markets. And these smaller banks began to operate. And so finally, we're going to examine the impact of this LBO entry and competition into these local bank portfolios. Our basic findings are that increased LBO competition in local bank markets is going to lead to higher local bank CRE concentrations. This effect is going to hold both for CLD and non-CLD, and it's going to be robust to a variety of LBO competition measures. We're also going to find that lower closed-end RRE and non-credit card consumer lending, these shares are going to drop as banks enter. The implications here, so basically what we're finding is that these concentrations are going to change. And the reason this matters for fragility is because reduced diversification opportunities and sector-specific shocks are going to be, banks are going to be exposed to these. So this interagency guidance, regulators were aware of this. So in 2006, there was interagency guidance that actually addressed these CRE concentrations. 31% of all commercial banks in 2006 exceeded at least one of these concentration levels of the specified criteria. And then for the fragility part, banks exceeding just the construction loan criteria accounted for over 80% of the FDIC insurance fund losses between 2007 and 2011. So this is a significant impact on the FDIC losses fund, and we're going to try to explore why this happened in the first place. So our results are actually predicted by theory. There's a lot of literature out there on competition in the banking system, but we think this quote from one of Alan's papers actually does justice to what we have in mind for how competition works. So small banks, Alan says in his paper, small banks are better able to collect and act on soft information than large banks. In particular, large banks are less willing to lend to informationally difficult credits. So this is the theory, and this is the story that we have in mind when we're thinking about our results. So basically, large banks are moving in, they're expanding geographically across the country. There's another set of banks who are not expanding in the same way, they're staying in their local markets. And this is producing competition, and what happens is those large banks are gonna take the credits that they can basically FICO score. It's the credits that they can commoditize. And small banks are going to actually start to lend on the information that they know. So they know the local markets, they know these borrowers better than anyone else, and they'll start to take on the credits that basically require more monitoring and more time invested into the credit. There's also a large literature out there on the impact, looking at these state regulations and the impact of the deterioration of local banks. So this is just a map of the branch locations of large banks over time. So at the start of our sample, we're going to define a large bank as a bank with more than $50 billion in total assets, in real total assets. So in 1990, most of these large banks were operating on the coast and in major markets. So you can clearly see the impact of New York and Boston and California. And then as of June 2005, you can see that these banks have expanded. So the density on the coast of the branch networks has improved or gotten more dense. And you can now highlight major cities across the Southwest or Southeast and the Midwest. So we can see Kansas City, St. Louis, in Minneapolis, for instance. So these large banks are moving both more densely on the coast and moving inward as well, and moving into these markets that were previously dominated by smaller local banks. As a result, the share of local banks that are facing competition, so we have locational data on bank branches, and we're going to define the competition as, in this case, a large bank operating a single bank branch in a county where a small bank is operating. So this goes from virtually very little competition in the mid-'80s to significant competition. Almost everyone is facing competition from a large bank in the 1990s. Or sorry, in 2005. And then this sort of slows down afterward once we get to the crisis period and the M&A activity slows down. So what we want to do here is test across this how loan shares change. And so the first thing we're going to do is something very simple. We're just going to look at what happened to loan shares before. So this is loans as a share of total assets. What happened to this before large banks entered, and what happens after large banks enter. The first plot here on the top left is going to show you commercial real estate. So this is the main one that we're interested in. So before large banks entered these local bank markets, we see very little effect of very little change in the share of commercial real estate over the years. So the x-axis here is showing you the number of years before an LBO entered a local bank market. After LBO entry, these shares creep up pretty steadily over time. So 5 years out, we're at about a 1.5 increase. We see almost the opposite happening for the residential real estate markets. So residential real estate was actually increasing. The shares were increasing at local banks prior to the LBO entry. And following entry, this trend basically stops and then it starts to decline, although it's not at a statistically significant rate. And then just looking at a couple other core loan portfolios, commercial real estate, we don't see any changes both before and after. So the shares are virtually unchanged after entry. And consumer, again, it's not really statistically significant on either side. So this is our story in a nutshell, is that these large banks enter the local bank markets, they commoditize residential real estate loans, and small banks move to these informationally sensitive credits, which are generally commercial real estate. What we're not doing in that previous regression, though, these are basically just correlations before and after. We're not controlling for market conditions, we're not controlling for bank conditions, or any of these other factors that may be driving what we see. So that's what we're going to do here. So in this case, we're going to run a regression looking at loan shares. We're going to control for all those local factors. We're going to look at population, per capita income, so the wealth and the size of the market, and building permits. And we're using building permits as opposed to, say, home price growth because we get more counties. So generally, we don't have a house price index for every county. And then we're going to control for bank level variables. And we're going to pick 5 measures of LBO competition. We're going to use branch and deposit market share, branch and deposit HHI, and deposit level in logs. And then finally, we have this issue where our competition measures may be jointly determined with our shares. So if a bank is increasing its share quickly in, say, residential real estate, this may actually prompt the large banks to move in and compete, as opposed to any sort of exogenous entry. So to do this, we're going to model the threat of entry. So yesterday we heard a lot about difference in difference. We're using a slightly different technique to establish causality. And to do this, this is where the state regulation comes in. So we're going to look at a CBO that's headquartered in a state, and we're going to look at all the states that have reciprocal agreements with that state throughout this time period that allows entry into that market. And if the home state has a reciprocal agreement with this other state, we're going to look at the LBOs that are headquartered in that state in all of their branches. We're going to measure the distance from the CBO to all of those branches and take the minimum. So what this is doing is, first of all, picking up the fact that that we have these reciprocal agreements, and we're also looking at the proximity. So the idea here is that if an LBO is headquartered in New York and I'm in Kansas City, Missouri, I shouldn't be that threatened by a bank that's operating in New York, but I should be threatened by a bank who operates out of New York and also has branches in, say, Kansas City, Kansas, right? It's a small leap to enter my market. And this is well known in the relationship banking literature. So, we have to make this assumption here that banks are not going to change their portfolios based on the threat of entry. They're actually going to change their portfolios once they just get outcompeted and they have to look for new lending opportunities. And from the theory, we know that that local bankers or relationship banking is actually costly to set up. So you establish this relationship with your customer based on the future profits, not on the profits that each individual loan is going to create. It's sort of like a revenue stream or a set of profits and that's the theory that we're using to justify the fact that this is only driving HHI or competition measures of the large banks, not changes on the local bank balance sheets. So just quickly, I want to get to our next result. So I've already went through this a couple of times, but we find basically what the other results had highlighted. Commercial real estate concentrations are increasing. Residential real estate concentrations for 1 to 4 family closed-end are falling. I think the home equity results, we find a positive effect there, but this is actually, I think, being driven just by a few outliers. If you look at the summary statistics, there are a few banks that actually have any notable concentrations or asset levels in home equity. And then the consumer results we find actually contrary to what I showed you before. Consumer loan shares are falling, and they're falling for the non-credit card portfolios. And this makes sense because credit card business is generally very concentrated at large banks. We wouldn't expect the competition between the local banks and the large banks there. So one thing that we lack is loan level data for all of these portfolios. We don't actually know where the loans are being made, but we do know where loans are being made for residential real estate lending. So we have county level originations from large banks, and we're going to use a different set of deregulation measures. So this is interstate branching deregulation restrictions, and we're going to look from 1995 to 2005. And this is going to avoid any of that concern that banks are moving into markets because the local conditions are preferable. And this is just a plot of the market shares. So residential real estate market shares are climbing for large banks, falling for small banks over this time, and no change for the non-banks. And we find this in our regression analysis as well. We find that loan growth is slower for community banks that are operating in markets with large banks as these deregulate. So just very quickly, I'm over time in my conclusions. So greater LBO activity leads to larger shares of CRE loans at CBOs and RBOs, smaller shares of RRE and consumer loans. And I want to just point out here that we're very agnostic about the competitive mechanisms that are driving this result. So a few that we had in mind when we wrote the paper originally was funding and technology advantages. So too big to fail gives you advantages in funding. And there may be platforms that large banks have access to sooner. But since we went through the mortgage data, we actually thought a little bit more about regulatory arbitrage. So large banks may set up independent mortgage companies that lend these residential real estate loans that small banks generally don't set up. And this is just a way to arbitrage the regulatory system potentially. So those are my comments. Thank you.